So you want to do what Michael Saylor did. You watched one man take a quiet, half-forgotten software company, point it at Bitcoin, raise billions of dollars, and watch the stock go straight up. And somewhere in the back of your mind, a thought started forming. I could run that playbook myself. Buy Bitcoin with other people's money, let the stock climb, and turn a pile of borrowed capital into a fortune. It looks like the greatest money glitch of the decade. It is not. Because you are not buying Bitcoin. You are taking a job. The job of feeding a machine that is always hungry, that has to be fed a little more every single month, and that has already started to eat itself. Here is the first number that should stop you cold. The company that invented this playbook, the one you want to copy, is now worth less than the Bitcoin it holds. As of early 2026, Strategy owned roughly 843,000 Bitcoin, worth about $55 billion. Its stock market value was only $43.5 billion. So the blueprint you want to photocopy is failing in public, right now, in real time. The machine still holds all the Bitcoin. The market has simply decided the machine wrapped around it is worth less than nothing. And to understand why, you have to understand the one thing the playbook actually sells. It is not Bitcoin. It sells a story. And the story is this. You have found a way to let ordinary investors own Bitcoin without ever touching it. You wrap the coins inside a public company. You list that company on a stock exchange, and then you sell shares in the wrapper to everyone who wants the exposure but not the complexity. The premium they pay for that wrapper, the extra they hand over just to avoid dealing with a wallet, that is your profit margin. That is the entire business. The MNAV, which stands for market value to net asset value, is the number that tells you how much the market is paying for your wrapper on top of the coins inside it. When Strategy was running at its peak, that number sat above 2.5. Meaning investors were paying $2.50 for every dollar of Bitcoin the company held. That 50% markup, multiplied across tens of billions of dollars of Bitcoin, is an enormous amount of money to raise. And you raise it simply by issuing new shares. That is the machine you want to build. And here is the first thing you need to understand about it. The machine does not run on Bitcoin. It runs on belief. The moment investors stop believing the wrapper is worth more than the coins, the machine stops. And right now, for the company that invented this playbook, that moment has arrived. So before you copy the playbook, you need to understand what the playbook actually is. Because from the outside, it looks like a Bitcoin trade. From the inside, it is something far more complicated. It is a capital markets machine, and building one costs more than you think, in ways that have nothing to do with the price of Bitcoin. Let us start with the fantasy version, the one that looks so easy. You raise a little money. You buy Bitcoin. Bitcoin goes up. Your stock goes up even more, because investors pay that premium for the wrapper. A higher stock price lets you sell more shares at an even better price. You take that new money and buy even more Bitcoin, and the wheel turns again. Each turn you own more coins and your investors feel richer. It looks like a perpetual motion machine that prints money out of pure belief. Here is what that wheel actually needs to keep spinning, and this is the part the fantasy leaves out. It needs the premium to stay above 1 at all times. The entire trick is buying Bitcoin at market price, using money you raised at a markup. If your stock trades at a premium, every share you sell brings in more dollars than the Bitcoin it will buy, so each raise makes your existing shareholders richer per share. This is the thing that makes the machine special. It is called accretive dilution. You issue more shares, and somehow everyone still ends up owning more Bitcoin per share than before. It sounds like magic. But flip the premium below 1, and the magic reverses instantly. Now every share you sell brings in fewer dollars than the Bitcoin it buys. Each raise makes your shareholders poorer per share. The machine does not just stop helping you. It starts actively destroying the people who funded it. And there is no gentle middle. The number 1 is a cliff edge. Above it, you are a genius. Below it, you are running a slow-motion wealth shredder. That is the razor you have to balance on for as long as you own this thing. So the real cost of entry is not the money to buy your first Bitcoin. It is accepting that you now have to defend a premium, forever, against a market that can withdraw its belief at any moment. And to defend that premium, you will have to raise money on a scale that will surprise you. Look at what it took just to keep the original machine fed. In the last year alone, Strategy raised about $25 billion by selling new common stock straight into the market, through what are called at-the-market offerings. That simply means the company drips new shares out into the market a little at a time, at whatever the going price happens to be, day after day after day. $25 billion, in 1 year, just from printing and selling shares. To have room to print that many shares, the company had to give itself permission first. In late 2024, it asked shareholders to expand the authorized Class A share count from 330 million to 10.3 billion. That is roughly a 30-fold increase in the number of shares it is allowed to create. Picture a pizza. Every share is a slice. The company just gave itself permission to cut that same pizza into 30 times as many pieces. The pizza does not get bigger. The coins do not multiply because you printed paper. There are simply more and more hands holding thinner and thinner slices. Now here is the part that tells you who this machine really serves. That 30-fold expansion passed with about 56% approval, and the deciding voice was Michael Saylor himself, who controlled 47% of the voting power. In other words, the man running the machine voted to give the machine permission to keep diluting the people who fund it. If you build your own version, that is the seat you are choosing, not the investor writing the check, the operator holding the printing press. And the entire model depends on you being willing to keep pulling that lever, month after month, because the day you stop raising money is the day the wheel stops turning. And here is where the fantasy of being the boss gets complicated. You imagine that running this machine means you are in control. You are the one buying Bitcoin. You are the one printing shares. Surely you hold all the power. But look closer at the structure, because even Saylor, the man at the very top, is not as free as he looks. To keep total command of the company, he had to build a special kind of share for himself. He holds Class B shares that carry 10 votes each, while ordinary Class A shares carry 1 vote each. As of the middle of 2024, that let him control roughly 53% of the total voting power, while owning only about 10% of the actual company. Think of it like a card game, where one player was dealt 10 times the hand everyone else got, and the rule was agreed before anyone else sat down. That is how he keeps the printing press in his own hands. So to run this machine, you do not just build a company. You build one where you can never be outvoted, because the moment you can be, someone else decides when to buy and when to sell. But here is the trap. That total control over votes does not give you control over survival. Because sitting underneath your common shares is a stack of people who get paid before you, and who do not care about your vision at all. Below your equity sits more than $8 billion in long-term debt. Below that sits nearly $8 billion more in preferred stock. Preferred stock is a class of investor that must be paid its dividend before common shareholders see a single cent. Think of a line at a cash register. The lenders get paid first. The preferred holders get paid next. You, the visionary founder, are standing at the very back of your own line. And that line is expensive, and it never goes away. The preferred stack carries a weighted average cost of about 9.73% per year, and the newest series pays 11.5%. On over $10 billion of face value, the preferred dividends alone come to close to $1 billion every year, paid out every single month, whether Bitcoin is up or down, whether you feel like it or not. So you may hold all the votes, but you have handed the real control, the control over your cash, to a stack of creditors who will be knocking on your door on the first of every month for the rest of the machine's life. So who pays that billion-dollar bill every month? You would assume the underlying business does. After all, this is supposed to be a real company. And this is where the numbers get uncomfortable, because the business inside the machine cannot come close to carrying it. Set the Bitcoin aside for a moment and look at the actual operating company, the way you would inspect a house before buying it. Strategy sells business intelligence software, the tools companies use to turn their own data into charts and reports. That business brings in roughly $124 million in revenue per quarter, and that number has barely moved in years. The gross margin on it runs around 70%, which is genuinely healthy for software. But gross margin is not the money you keep. It is only what is left after the direct cost of delivering the product. Everything else still comes out. Operating costs for that software segment run about $180 million per quarter, once you add up salaries, cloud computing, sales commissions, and overhead. The median employee earns about $91,000 a year. Subtract those costs, and the software business barely breaks even, and in some quarters it loses money outright. In the third quarter of 2024, the company reported a loss from operations of more than $430 million. Now hold those two facts next to each other. The software business generates less than $500 million of revenue in an entire year. The preferred dividends alone cost close to $1 billion a year. That is roughly twice the entire revenue of the operating business, and that is before the interest on the debt, before the cost of running the company, before anything else. There is also a quieter cost hiding in the convertible notes, a form of debt many of which carry a 0% interest rate. That sounds free, but they convert into new shares when the stock rises. So the moment your stock does well, your shareholders get diluted all over again. The bill never appears on the income statement, but it is always being paid. So the machine you want to build has a hole in the bottom of it. The operating business cannot pay the financing. It is not close. There is exactly one thing on Earth that can fill that hole, and it is Bitcoin going up fast enough to justify selling more stock to cover the gap. The moment Bitcoin stalls, the moment the premium fades, the hole is still there, and the water starts coming in. So if the software cannot pay the bills, why keep it at all? Why not just be a fund that holds Bitcoin? This is the cleverest part of the whole design, and if you copy the playbook, it is the part you must copy exactly. The software is not there to make money. It is there to be a costume. A company that simply holds Bitcoin is treated by regulators and index committees as an investment fund. A company that sells software and happens to also hold Bitcoin is treated as an operating business. Those two labels live in completely different worlds. The operating business label is what lets the stock get into major indexes, keeps regulators at arm's length, and keeps the doors open to raise money in public markets. So the software does not need to be profitable. It just needs to exist so the machine can wear the costume of a real company while it does the only thing it actually does, which is turn belief into Bitcoin. That is the honest description of what you would be building. Not a technology company, not even a Bitcoin fund. You would be building a leveraged Bitcoin treasury funded by perpetual preferred stock and convertible debt, wearing a software company's clothes so it is allowed onto the stock exchange. And the hidden loss center, the wound at the center of it, is the permanent gap between what the financing costs and what the operations can ever bring in. Now, before you decide you can run this machine better than anyone, you should know that this exact company has broken in public before, more than once, and each break comes back to the same crack. The gap between the story and the numbers underneath it. Go back to the year 2000. MicroStrategy was a high-flying software stock, trading above $300 a share. Then the company admitted it had overstated its revenue for 3 straight years. The stock crashed 62% in a single day. More than $11 billion in market value evaporated between one morning and the next. The Securities and Exchange Commission brought enforcement actions, the company paid millions in fines, and agreed to sweeping internal reforms, and a class action lawsuit alleged damages of more than $600 million. That was the first time the distance between the story and the numbers caught up with it. Here is the second break. In August of 2022, the Attorney General for the District of Columbia sued Michael Saylor for tax fraud, alleging he had avoided more than $25 million in local taxes by falsely claiming he lived somewhere else. The company was accused of helping him do it. In June of 2024, Saylor and the company reached a $40 million settlement. They admitted no wrongdoing. They paid anyway. And now there is a third. In 2025, a new class action was filed, covering the period from April of 2024 to April of 2025. It alleges the company made false and misleading statements about the profitability of its Bitcoin strategy and the size of the losses it could face under new accounting rules. The lead plaintiff deadline fell in July of 2025, and the case is active in the Eastern District of Virginia. 3 cases, across 25 years, all circling the same fault line. This is the track record of the blueprint you want to copy, not a rumor about the future, a pattern that is already repeating. And now for the risk you would never think to plan for, because it does not live inside your machine at all. It lives in the hands of a few committees that decide which stocks the world's index funds are forced to buy. This is the hidden engine behind the whole premium, and it is the one lever you can never touch. Here is how it works. When a stock gets added to a major index, every fund that tracks that index has to buy it. Not because a manager studied the company and liked it, but because the rules say the fund must hold whatever the index holds. That is a wall of automatic buyers who never look at the fundamentals. For a while, that wall was pushing money into this stock, and that manufactured demand was part of what held the premium up. If you build your machine, you will pray to be let inside those indexes, because that is where the effortless buyers live. But the same rule that forces buying can force selling. In late 2025, MSCI, one of the largest index providers in the world, proposed a rule that would exclude any company where digital assets make up more than half of its holdings. That points straight at this kind of machine, where more than 95% of the value is tied to Bitcoin. If it passes, the passive funds that track MSCI indexes would be forced to sell all at once, whether they want to or not. JP Morgan estimated those forced outflows could reach anywhere from $2.8 billion to $8.8 billion. That is not a guess. It is a calculation of how much passive money would be dumped the moment the rule flips. The company fought back. It hired lawyers, filed public letters, and argued it should be treated as a Bitcoin operating company rather than a passive holding vehicle. But the index committee does not read the marketing. It reads the balance sheet, and the balance sheet says Bitcoin first, software second. There was one win in the other direction. The stock was added to the NASDAQ 100 in December of 2024, forcing those passive funds to buy. but the larger S&P 500 stays out of reach because the company cannot consistently report positive earnings from its actual operations. So the lesson for you is brutal. The demand that inflates your premium is controlled by people you will never meet, in rooms you will never enter, and they can switch it off with a rule change you cannot vote on. Which brings us to the promise that holds the whole thing together, and the day it broke. The machine only works if everyone believes you will never sell the Bitcoin. That is the foundation. Michael Saylor said it plainly. Bitcoin is the exit strategy. Never sell. The preferred investors handed over their billions partly because they trusted that the core pile would never be touched. It was the thing that made the whole arrangement feel safe. Then, in May of 2026, the company did the one thing it swore it never would. It sold 32 Bitcoin to raise cash for its preferred dividend payments. The amount was tiny, roughly $2.5 million, but the meaning was enormous. It did not sell for some grand strategic move. It sold to pay a routine monthly bill. That is the tell you cannot miss. When a machine that swore it would never sell ends up selling a sliver of its core just to cover the dividends, it is confessing that the operating business can no longer feed the financing. The preferred stock then slipped below its $100 starting value, which quietly made every future round of borrowing more expensive. The machine became costlier to run at the exact moment it could least afford it. Now think about how you would ever get out. Because getting into this game is easy. Getting out cleanly is close to impossible. The value of your stock does not rest on profit or cash flow. It rests entirely on the premium other people will pay for Bitcoin wrapped in your corporate structure. And by late 2025, that premium had not just shrunk, it had inverted. The company's market value fell below the value of its Bitcoin for the first time in years. The wrapper became worth less than the coins inside it. The magic ran in reverse. And here is the final blow. The reason the premium may never come back. There is now a simpler product sitting on the shelf right next to yours. A spot Bitcoin ETF charges a management fee of less than 1%, holds Bitcoin directly, and carries no debt, no monthly preferred dividends, and no founder who can dilute you to fund his next purchase. So ask the question every one of your investors is now asking. Why would anyone pay a premium for a leveraged, indebted, diluted version of Bitcoin when they can buy the clean, direct version for almost nothing? Most of them have started answering with their feet. The stock has fallen nearly 79% from its peak. The buyer pool has shrunk to true believers who accept the leverage and the complexity, a far smaller crowd than the index funds and eager newcomers who once drove the premium up. So if you ever need to sell, you are hunting for a buyer at the precise moment the market discovered it can get the same thing simpler, cheaper, and without you. So step back and look at what you were really about to build. You thought you were going to buy Bitcoin the smart way, the Saylor way, using other people's money to get rich off a coin you believed in. But that was never the machine. The machine does not buy Bitcoin. It sells a premium. It survives by convincing the market that the wrapper is worth more than the coins inside it, and then quietly turning that belief into more coins. And that belief is a story. Stories have half-lives. When the story weakens, the premium shrinks. When the premium shrinks, the financing costs rise. When the financing costs rise, the machine slows. When the machine slows, the stock falls, and the story weakens a little more. It is a loop, and it runs in whatever direction it is already moving. On the way up, it looks like genius. On the way down, it reveals itself as exactly what it always was. So you can copy the playbook. You can build the company, print the shares, and buy the Bitcoin with money that was never yours. But what you are really building is not a Bitcoin treasury. It is a bet that new believers will keep arriving faster than old ones leave. And the supply of believers has never, in the history of any market, been infinite.